Okay, welcome. Have a seat. Thank you so much for coming out. This is the second meeting of, or the second public forum for New America's Energy Advisory Council, which is a project over the next 6 months to kind of sit down and really talk through some of the aspects of the Obama energy initiative or Obama energy sort of suite of policies to think through how they're working and look at some of the pitfalls down the road. And thank you very much for coming to this one. This one is about oil. Probably in listening to the news, you wouldn't necessarily get a sense that we have started down the road to a very dramatically different new oil policy. As far as I know, there's no central document on what the Obama oil policy is, but there's a whole suite of initiatives scattered through all sorts of different policy areas, ranging from the auto task force to CAFE standards, to money in the stimulus bill that's being used to both change technology and fund companies like Tesla, the electric auto company. In addition, there are a lot of other different policies, including the electric vehicle mandate and the biofuel mandate, and a set of taxes and policy incentives. So we're here today to talk about all of those things in the context of oil and try to knit them together and look at where they may be going and where we may end up. Now, today is the day, the beginning or the day of the State of the Union address, and I would say that almost no number is more central to Americans' feeling of well-being about the State of the Union than the price of oil. That is just such a central number in our culture. When you drive down the road and you see that price, and you get, even if you're not the sort of person who reacts to sports numbers, and you pride yourself on being a little bit outside the culture, you look up and you see that gas is $3.25 a gallon, and you can't help but go because it has, we have a very, very visceral relationship to the price of oil. And the price of oil is actually relatively high this week. We don't know where it'll go. It's certainly not at the highs of 2008. And one of the questions that we'll talk about today is, what is the possibility of having another 2008 sort of oil high? And what would that mean if oil were, say, $200 a barrel? How would that change some of our plans? But to back up, here we are. It's the State of the Union Day. And the U.S. Political landscape is really unsettled at the moment, I would say. We have the lingering effects of the recession. We have the auto industry still trying to recover and to set up a new path. We still don't have carbon regulation. We didn't succeed in getting something through either Congress. We didn't succeed in passing Waxman-Markey. We haven't succeeded in passing the others. We also didn't get an agreement out of Copenhagen. So we have this regulatory uncertainty. We have price uncertainty about oil in the oil markets down the road. We don't know exactly where we're going. And we know that the market is now behaving in different ways than it did, say, 10 years ago, when people were worried that the price, their main worry about the price of oil was that it was going to be too low. There was a famous article about $7 a barrel oil that came out in Foreign Policy. And that is now no longer the concern that we have. So we also have the changing sort of political landscape, in that consumers and voters are starting to get worried about perhaps where big government is going, or just get confused by the number of initiatives that are bouncing around them and the number of claims. So we come at this at a very interesting time. We have uncertainty, political uncertainty, we have economic uncertainty, and we have tremendous regulatory uncertainty going forward for our auto industry, for the oil industry, for consumers using carbon. So what we're doing here today is to talk through some of this and talk about where we're going, and also kind of think through what the priority should be for policies on whether we choose to emphasize regulating carbon, encouraging energy security, or perhaps fostering the growth of jobs. And all of this is very central to this discussion of the auto industry, oil prices, and also consumers. What's exciting today is we have an amazing panel. We have Russell Helmsley from McKinsey in Detroit. He's spent almost 2 decades looking at the world's auto industry, and in particular at Detroit. He'll be talking somewhat about Detroit's fuel-saving initiatives. He'll also be talking about the possibilities for electric cars. And then we have Kevin Book from Clearview Energy. He has, I don't know how many decades he spent studying, possibly not that many. 1. Okay.
A little over 1.
From the looks of it. Okay.
I have fewer decades available.
Looking at oil markets and the interaction of policy and markets. And what's exciting about this is over the last week I've been calling a lot of oil experts and trying to get them to tell me what they think is going to happen over the next 6 to 8 years. And one thing they've all said is something along the lines of, I don't know what Detroit's doing. I don't talk to Detroit. And so what's very exciting here is we have oil and Detroit in the same room. And even more exciting than that is that we also have consumers in the same room, because consumers are very much the wild card in all of this. They have tremendous political power, and they feel themselves not to have that much economic power at the moment. And so we have Dr. Mark Cooper from the Consumer Federation of America, who's been watching consumers' reaction to energy prices since the 70s. So what we're going to start with is a couple of quick presentations from the speakers, and then we'll have a discussion, and then we'll be going to questions. So, Russell, lead off. Here you go.
Might need that. Thank you. Thank you, Lisa, and good afternoon. I'm not sure that I represent Detroit, as you can tell from my accent. I'm actually from Ohio, not Michigan. But let's wait until these pages come up. Somebody know to put them up. You have to knock on the door. Can you just go through this?
Can you get Mike to start the PowerPoints? Sorry about that.
Actually, being from McKinsey, I can't speak without PowerPoints. So. You can go back to the beginning, please, or steal my thunder, whichever. Yeah, there we go. Okay, terrific.
There we go.
Okay,
There
now you've seen the presentation in reverse. So, all right. So good afternoon. I'm Russell Hensley. I'm expert associate principal with McKinsey. I'm in the automotive practice within McKinsey. I reside in Detroit, but spend most of my time either out of state or out of country. For the last, I think, as Lisa said, for 20 years, or 21 years, I've been in the auto industry. I have an engineering background. For the last 7 years, I've been at the firm. And for the last 2 years, I've studied climate change and the impact of climate change on the automotive industry on a global basis, which has given me the fortune of being able to buzz around the world, really talking to the folks within the industry and the folks within the emerging industry, the battery makers of the world, whether they're in Korea, China, Japan, Boston, wherever they would be, to try and get some perspective and to try and really develop what we believe is the way to think about this kind of problem, which is starting with a fact base and really trying to understand, there's a lot of myth in the industry, just how much headroom there would be with current technology or how much advantage future technology may bring. But I think to try and ground everybody, what we did was actually put out a report a few months ago which was actually entitled Roads to a Low Carbon Future, which again, the intent was to put out an independent fact base to really inform the debate. So I've got a bit of a story I'll buzz through quite quickly. It'll take about 10, 11, 12 minutes, something like that, but there's quite a few slides, so bear with me as we go through this. The auto industry is not having the best of times, as you don't have to be a genius to figure that out, right? If you look at profits since 1990, the industry has made increasing margin. This is the combined profits of the big players within the industry, not just the US. This is on a global basis. So you can see back in 2007, there was a combined profit of about 60 billion globally, which is quite significant, but not necessarily when you think of the size of companies. At its peak, GM had a revenue of about 190 billion. But then that's all well and good until we had the crisis, and then things fell off a shelf. And we actually made, obviously, losses last year. We're trying to still figure out exactly what that was. But clearly there was enormous change when you have a 30 to 40% drop in demand, which we had in the US as an example, going from 16 million to just north of 10 million units. You get enormous pressure on profits. The industry is one that thrives on scale. Making the industry a bit more challenging going forward is if you actually look at regulation, and if you look at some of the other mega trends within the industry going forward, if you look at it from a pure cost standpoint as opposed to an opportunity, emissions regulation on a global basis would cost the industry about 30 billion. Okay, it all depends on who actually pays for that, whether that's passed to the consumer or whether it's consumed by the industry or its suppliers, but it would cost about 30 billion. So again, it's a wee bit of a headwind at the moment within the industry. And then to add to that, we've got the challenge of CO2. What we did here was basically from a bottoms-up standpoint, look at the emissions that's actually generated from 06, 010, and try and project that over the next 20 years by the different regions around the world. Again, trying to inform the debate, whether it was Copenhagen. Actually, this was produced quite a bit before that. But you can see if we carried on as business as usual as an industry, it wouldn't be a very good story. We'd actually increase emissions by north of 50%. And you can see, again, the proportion from Europe and North America dropping from around 80% down to about 2/3 of that. The fastest growth being China, again, as they try and mobilize the nation. So you're facing potential growth. So have you got another tobacco industry on your hands here? Really. You then look at what the regulators are doing, and I show Europe here. I'll give you the contrast to the US. But regulation is increasingly stringent. What the European Commission did last year was bring into law the regs of, they set 130 grams of CO2 per kilometre, which is basically the carbon that comes out of the tailpipe of your vehicle over a distance of a kilometre during a normal driving cycle. The real emissions is significantly higher than that. It's about 25 to 30% more than that. But again, it's the one metric that again you can try and regulate the industry with. The interesting thing is on this side of the chart, right, over time, there's the 130, 125, depending on with a wee bit of biofuel in there, you come down to this lower target. But then in 2020, 2025, you come down to these levels of 95 and 70. 95 is a bit of a challenge for the industry. You can get there if the majority of your fleet is advanced internal combustion engines and some of it is electrified. The one that really concerns the industry in Europe, and again, this is the most aggressive regulation in the world, the one that concerns the industry is the 70, because you cannot get there with advanced internal combustion engine technology. Therefore, you have to go to a different source of energy. Okay, and that's based on what we know about internal combustion engines today. And the interesting thing for the automotive industry is if you look at really what drives innovation and what drives technology change, as you walk from the left to the right here, the left spike basically shows that you penetrate 100% of the fleet within about 5 years, within one vehicle generation. That is regulated technology. So if it's emissions related or airbags or safety related, it penetrates far faster than if it's comfort related like air conditioning, or if it's a kind of a niche technology, so a trunk security system or something like that, never penetrates the whole fleet. So what you can see is there's a very, very clear link between regulation and innovation, basically the penetration of innovation. Again, the first thing I said here was the industry is about scale, right? And scale drives down cost, which is a very, very important thing when you're trying to bring a product to the masses, because it has to be at a very competitive cost point. So what does the industry do? Well, the industry's got a couple of axes along which they can move. If you move along the kind of x-axis here, you can develop new powertrains. Internal combustion engines we're very, very familiar with. We've had them around for 120 to 130 years. Believe it or not, they've still got around 40% more efficiency in them by using some of the technologies that we have on the shelf today. You've got hybridization. Again, we were just talking, Kevin and myself, about hybrids. Again, beginning to populate. It's still only a couple of 3% of the fleet. It's not necessarily taken off in droves because, again, you've got a bit of a ding as a consumer because you've got that initial purchase price, which is the $3,000 to $5,000 more. You then move to electric. Again, electric vehicles. We've got an array of examples here. I'll show you some more in a little bit. But again, if you were in Detroit last week or the week before for the North American Auto Show, or if you're in Washington a bit later on this week, you'll see what we call Electric Avenue, where you've got a number of different products from a number of different players, and probably the most vocal OEM, not necessarily the leader, but the most vocal on EVs is clearly Nissan, and the drive to push the change by Carlos Ghosn. If you then move down the y-axis here, you can change the fuel. So you've got gasoline and diesel. Diesel's never taken off here. Again, it's about 2% of the fleet on a good day. Typically, it's heavy-duty trucks and used more for work purposes as opposed to personal use reasons. You can use electricity. We'll talk about that. You can use CNG or you can use hydrogen. Interestingly, if you read, I read a test drive of a BMW 7 Series internal combustion engine hydrogen vehicle. A journalist driving it around New York, and he was appalled because he couldn't actually go through tunnels in New York because the vehicle wasn't allowed to go through tunnels. We've still got this huge concern about safety of hydrogen, okay, as a nation. So safety is a hurdle, cost is a hurdle. You can lease an FCV if you're in Hollywood for probably $108,000 from Honda. Toyota say they've got a hydrogen model coming around 2015, but I think they've got probably as of today some bigger concerns to think about in terms of recalls, and again, probably a back to basics is what you will see from Toyota. So a number of options. If you deploy those options, how far can you get? Well, you can't get quite as far as the IPCC was saying, but what you can do, you'll recall the 54% growth by 2030, again, is in the business as usual world. If you deploy the technology or biofuels here, the assumption is we become Brazil. So it's somewhere between 35 and 40% penetration levels. That's how much it will give you. And it's first generation biofuel, by the way. It's not second generation, not cellulosic. And then if you have other levers like traffic improvement, driving behavior, or reducing the distance driven, again, you need to pull all those levers. You can clearly see that the technology in biofuels is a lion's share of how you can reduce it. But you can reduce to around 20% less than where you are today, which is quite remarkable. Okay, and we've got a few scenarios. Obviously, this is all dependent. A model is based on the assumptions, or only as good as the assumptions you put in. But in the ICE world, it basically optimizes the internal combustion. In the mixed tech world, it's somewhere like 20% mix of EVs. In the hybrid electric world, it's somewhere like north of 40%, around 50% electric. So again, just to give you a sense, and again, it's a little bit diminishing returns. And the electric solution, again, you will see as you walk through the various technologies here from what we have today. So this is looking at the emissions of the various technologies. You would say, okay, I can optimize the gasoline and do around 39-40% better than I do today. Interestingly, that brings the gasoline engine on par with diesel. Okay, so there's no longer a big advantage for diesel, right? Diesel fuel has got a wee bit more energy than gasoline. Traditionally, diesels have been turbocharged. Gasoline engines haven't because they run at a slightly higher temperature. right? We've overcome those challenges from an engineering standpoint with the various materials that we use. Actually, gasoline gets better. You then move to hybrids. Hybrids only give you an incremental benefit, but then you move to a different fuel. And what you have here is, again, a 70-80% benefit, but it's highly dependent, and that's what the dotted box is, on where the energy comes from and how it's produced. I've got those same charts on the left here, and again, I've looked at if the electricity is produced by nuclear, natural gas, oil, or coal. You can see that if it's coal produced, actually, it's worse than an optimized internal combustion engine. So if you put one of these vehicles on the road in China today, electric vehicle relative to an ICE, it would actually create more carbon emissions when you look at the total. Okay, that's quite sobering, because it's not just the solution to put the EV on the road, which has got its challenges, but it's also cleaning up the supply of electricity. I just paradoed the various countries there. In order for this to work, for EVs to work, the economics has got to work. One of the big challenges is the cost of the battery. These curves are based on, again, many interviews around the globe. You have very conservative voices by the manufacturers who you would traditionally think were conservative. You have quite aggressive ones coming from probably China and some within the US, some of the more aggressive US companies. We kind of hone in on that $500 per kilowatt hour, $500 per kilowatt hour in around 2013. So if you can imagine, you've got a vehicle with something like a 20 kilowatt hour battery. Again, that's a $10,000 addition. Okay, less a little bit of expense because you don't have quite as many components in there, but it's a $20,000 addition to the cost of your vehicle today. So the economics are a bit of a challenge, right? But moving through the economics, the cost of operation, you can the initial cost, of the vehicle on the left, you can see with the battery in there. If you depreciate it, the battery basically is the kicker. But then if you look at the operating cost of the vehicle, actually, relative to Europe, where gas price is 3-4x what I think Lisa described earlier on, and I'm quite excited when I see $3.50 a gallon or $4 a gallon versus $9-10 a gallon. But the advantage for an electric vehicle comes when you run the thing. The initial cost is going to be a difficult thing, and you've heard Nissan again talk about separating the battery and the vehicle, which they can do, and you actually lease the battery as a way to try and get around this, or you subscribe to a number of miles per year. More interestingly, if you look at the way that we think about things is total cost of ownership, so you're looking at the overall cost from an economic standpoint, and when you begin to look at this across two axes, this is the world without incentives, and on the left is the world with incentives. So when you put that $7,500 incentive in there, or $6,000 if it's a slightly smaller battery, what actually happens is, as you move, as the battery costs come down, right, the ICE becomes less favorable. The PHEV 40, this would be a Volt. This would be something like a Nissan Leaf. But once the battery costs come down or the fuel price goes up, so you were saying $370 or somewhere around there?
$325 in California today, but not here. Okay,
well, it's somewhere here you can see at that price, right, where we are today, it still makes sense for the ICE. This is the world that we live in today. Okay, because battery costs are probably north of 600. Again, once they begin to come down, where the TCO, again, consumers don't buy on TCO, but the fundamental economics would say that the EV kind of wins out from an economic standpoint, a total cost of ownership. Challenge is consumers, like I say, don't buy like that. When you ask consumers, and again, I think Dr. Cooper will probably speak to from a far more solid base than I. But when we polled consumers, this is about 18 months old. What's important when you're buying a car? They will tell you it needs to be good value for money, reliable, okay, handles well, so on and so forth. When you get to the fuel cost, right? So remember, fuel cost. This was before the spike in 08, but fuel cost was kind of 13 out of 17. Do my bit for the environment, 15. Available with some kind of advanced technology, I don't really care. Right? It needs to be good value for money. It needs to be reliable. That tells me that the EV needs to be good value for money and it needs to be reliable. Right? And again, when we haven't built batteries at the scale that we're talking about, at the size we're talking about, that may, again, be some of the teething problems that we'll have to work through here. There is a part of the population that is super green, right? They will buy hybrids come hell or high water, right? and like it and talk about it and be thrilled about it. The challenge for the industry is that segment, the traditional way that the industry thinks about segmentation, cost optimized, wants it all, so on and so forth, dynamic drivers. But the folks that want EVs basically are spread across all of those segments, okay? So it's not necessarily, it can't be approached traditionally by the industry. One place where it can be is within a megacity. We just finished a study with New York, Shanghai, and Paris. You will have seen, I think, a release from Mayor Bloomberg about a week ago speaking of this. Basically, we polled New York consumers, and we found that around 16% would be early adopters. So not necessarily concerned about having the infrastructure out there. They're happy to charge at home, happy to charge at work. Okay, these guys or these folks don't necessarily commute a long ways, but again, it's reasonable size. By 2015, you're talking around 70,000 units. May seem like a big number. For the industry, it's not. Right? For the auto industry, typically, an example of Ford Taurus, you get 200,000 off the end of the line every year. Okay, it's roughly one a minute if you go into an auto facility. Right? So 70,000 spread amongst, if that's the size of the pie, it's not very big. So what I have to do is I have to link up New York with Boston and other towns and begin to make a sizable market. Okay? And then what does it do for the industry? It changes the value chain. It throws it on its head. Basically, you've got traditional OEMs, non-traditional OEMs. You've got a bunch of market power generation players, the transmission, distribution. It comes together with vehicle charging. The battery industry is going crazy. This is kind of 2008 shipments. This is going to change. A lot of familiar names, a lot of unfamiliar names. BYD, Chinese company that's leading the way for China, at least in terms of headlines, for the electric vehicle movement, LG, and so on and so forth. And that's what the industry's response is. Again, volumes are small. They're in the thousands. It's going to be I think a delicate walk over the first couple of years. Again, you've got durability, reliability, things that you have to work through. You've got a selling proposition that's going to be a wee bit different to the consumer. You've got regulations around the world that are fundamentally different, where you've got the European, which is saying you must have a new kind of energy. Here, you can get by with what we have currently if you advance it. And then you've got other countries like Israel, for energy security reasons, are saying, okay, we're going gung-ho. And you've seen, again, over the last couple of days, some big investments. I think 350 million investment going into Better Place within Israel from HSBC and I think Morgan Stanley. So again, just to give you the sense, the industry's waking up and clearly is being woken up further by these startup companies. Okay.
Thank you.
Sorry if it was quick.
Okay, Kevin. Thanks.
Now, if I pull the trigger here, I'll get to the next.
Yeah.
Oh no, I've gone.
Oh, you have to switch presentations. I think.
I believe it's the.
If I just do really fast, so no one can see any of the. There we are.
There you go.
Okay.
Uh-oh. Did he use the PowerPoint or did he use the PPT? I have this horrible fear that all the scaling will be wrong. And it is. Is there any way to get
With that?
It'll look bad to everyone all the time. And after such a nice presentation, as McKinsey puts out, is there any way to get the PDF file? If not, that's fine.
I'm not sure that he can load it right now because he loaded them serially.
Okay.
I think
Load a separate file.
Right. Could you, if he could load a separate file,
Okay.
that'd be super. If
So-
not, in any case, sorry to delay you. I'm Kevin Book.
talk.
I am an energy analyst who looks primarily at oil, alternative energy, and the policies that change the adoption.
You can't switch it.
You can't? Okay, fine. Adoption and diffusion of different energy technologies and fuels, which means I look at a lot of the same things that our prior presenter looks at. I look at them ordinarily with very painstakingly written small presentations designed for financial investors who like to scrutinize flip books despite all the computer power they have at their disposal and sneer at the analysts who prepare them. And so it's usually made for paper. And so in an effort to try to reach the broader room today, I reformatted, apparently unsuccessfully, to make them all bigger. So I do apologize for the formatting. But the good news about my job is that all you have to do is figure this out. Just explain why this happens and what's going to happen next. It's relatively easy. By the way, if you just want to talk like an economist does, which doesn't work in this town or really in anyone's home, you can point out that on an inflation-adjusted basis, and you just sort of take a linear trend line, oil is really not that much more expensive than it ever has been, more or less, except that line is totally uncorrelated with the relationship to the peaks and the valleys. Safe to say, 99.55 and change, or in constant 2007 dollars, got a lot of people's attention. So when asked, how do you explain all this, it would be very easy to sort of say, well, X equals AY plus BZ plus some error term I can't find. Except it's never worked that way very well. Price versus global surplus capacity looks at the oil in the world. It's usually a very good way to look at the price of a commodity. Commodity curves are hyperbolic, and if you draw a linear regression, you're going to have some problems making good estimates at the far ends of the regression. We are now off the chart when it comes to trying to figure out how much surplus capacity should determine price, because we haven't had this much in anyone's data set. Most analysts won't admit that. Second, there's refinery capacity utilization. How much are the commercial customers of crude oil operating? Right now in the U.S., they're operating at 78 or 79%, which is a historical low. Decades have passed since we were last here, and it's unprecedented in sort of a theoretically non-interruption environment to have this kind of low capacity. That too makes it difficult, but in theory, the more they're running their refineries, the more the demand for crude would push up the crude price. Price versus currency, a fun relationship that works until it doesn't. The problem is that when the dollar falls, it means our economy is sick. We are still, for 3 to 4 more years, the marginal consumer of oil, which means that when our economy is sick and oil is an industrial feedstock in our economy, guess what? It comes back down, and it did so violently in the fourth quarter of 2008, aided by many of my clients, former clients, running for the exits. The geopolitical risk premium doesn't exist with this much surplus capacity unless everything goes wrong at once. We've been looking at that extensively and trying to figure out when it's going to happen. Stay tuned. Not there yet. Price versus GDP growth. This is the theoretical growing industrial economies use more oil, except that it depends on how tight a correlation you want. If you're happy with the one I showed you on the previous slide, you're the kind of economic student that we probably don't want to hire. But if you're looking for something that we'd call sort of a high correlation, I'll show you the numbers if you care. It's only about 25% of oil demand in the last sort of cycle, the 2003 to 2008 cycle, was correlated to GDP growth, which means that something else was going on. Speculators, well, that they can be a factor on the way up. They can be a factor on the way down, especially in 08. But they're not particularly predictive. They're also not particularly good at what they do. A lot of them bet long at the wrong time. And they help to accelerate the price trend downward at the end of 2008, but not to the benefit of their investors. And finally, the supply growth demand cover relationship, too hard to follow. So what are you going to do? You end up doing exactly what our prior presenter and probably our subsequent presenter do. You sort of think about who uses the stuff. Now, if you can find out what all the wells in the world are going to do and where all the oil in the world is, you've already surpassed all the expertise in the oil industry writ large. So I've been successful, or somewhat successful, looking at demand. On that surplus capacity relationship, like I said, you'd want to look here. Don't. Okay, here's the future, though, and this is where the surplus capacity relationship matters. Right now, we're sleepy. I think Bruce Pickens' ad says something like "Go back to sleep, America." Well, actually, it is kind of a sleepy time for oil demand. We are weak in our demand growth in the primary markets because it's been weakening. And the racing ahead markets, the far eastern demand that everyone's talked about, pushing us over the precipice, we just gained so much surplus headroom in the world that precipice is further away. So, again, imagine a hyperbola. I can move a little bit at this point on the curve and have very little change in price. I can move a lot and still not have very little change in price. At the other end of that curve, though, when it gets steeper, I can move just a little bit in demand and price can rocket ahead. Well, that can happen. And in fact, if supply doesn't catch up to demand, or something else doesn't happen, we could be in for kind of a rude awakening from our sleepy time, 2013 or 2014. A lot of this presentation from here on is about the something else that can happen. Whoops, and I just jumped too far ahead. Before we get to that, though, the relationship, if you got to what the prior chart suggested, which is that we used up basically all of the surplus crude capacity, if you norm for the expected demand response, you have a kind of a grim-looking future. You could see that $200 price that everyone was talking about a couple years ago. It's our contention you won't, and here's a couple reasons why. Oh, and for those who wanted to hold me accountable on the numbers, you don't have a flip book, but hopefully, here are the numbers. If you're very lenient in your statistics and you only care about 25% relationships, then 2/3 by a Pearson correlation coefficient, by a Pearson R squared is 51%. It's not very correlated recently. Why? Okay. Well, the theory is that people drive less when the price goes up. That's a theory, and it wasn't at all true. The UC Davis Institute of Transportation Studies showed between 2001 and 2006, not only was that relationship 1/10 of what it was at the end of the 1970s, the last 5 years of the 1970s, in many cases it didn't exist at all. I, for years, was very unsuccessful predicting demand, looking at what I called consumer energy leverage. It occurred to me to think a little bit about the consumer, the end user of this energy, end user of the cars. They drive a certain number of miles per year, but they also buy electricity and home heat, and they have a certain amount of disposable income. Look at that fraction and see what happens. Wasn't predictive either. Something else must have been going on. It's our theory, I think a pretty well accepted one, that access to credit played a role. While we're talking about the consumer, let's stratify him or her by income quintile. Who uses gasoline in America? Well, rich people use most of it. And so that's not surprising because they can do the most discretionary driving. Also, by income quintile, the poorest people use the least of it. But there's some interesting things when you look at the third and fourth income quintiles who are sizable users of gasoline. The interesting thing, and you can't see it well on this chart, is that the price responsiveness of the fourth income quintile is less than the price responsiveness of the fifth. Okay, what is that in English? People who are sort of making slightly more money than almost none are driving apparently the same amount when price changes as compared to people who are either richer or poorer than they are. Why? Well, there's a lot of really good reasons, but the most easy one to explain is some combination of sprawl and economic necessity, which is that they live a long way from their work. That means that any price increases, when you think about who it affects, it's always easy to say it's regressive. It's not perfectly regressive because there's a group of people who are really adversely affected, and they are that fourth income quintile. Consumer energy leverage, my pretty pie charts, went from 6.76% on a national average basis to 9.58% on a national average basis, which means that in basically between 2002 and 2008, you had about a 3.5% change in your after-tax disposable income available for stuff because of home heating, electricity, and gasoline. If you are the national average consumer, who I've never met and I've never lived in a national average household. It's probably worth mentioning that consumer's debt problems were mounting throughout that time. Her access to credit has just been clipped. The Card Act has given a lot of the same lenders who were lending to the third and fourth income quintile lower credit limits to work with, which means that their behaviors may be different on the way up. This is very hard to see, but on a BTU per jobs basis, this recovery, so this is a weird way to look at it. Most people look at other things, and that's why I look at this. It turns out there's a really good relationship between GDP and jobs. There's also a really good relationship in America between GDP and BTUs. And it turns out that if you just sort of say, well, we know that we've had sort of a jobless recovery. What does it mean for the energy consuming patterns of our country, not just gasoline, but everything? It's about 15% flatter than the last recovery so far. And I say so far because the data just aren't there yet. On our national average question, it's great to be from California. Your consumer energy leverage went from 4.97% to 6.59%, but not necessarily if you lived in Modesto. Probably much more on a statewide average basis. Again, statewide average consumers are as non-existent as national average consumers. This is a different variant of the chart you saw before, which looks at the same exact things that we saw from Detroit, which is you've got a fuel and technology choice. And what I'm suggesting in this chart is when we were looking at expanding into ethanol and diversifying fuels for energy security in the last administration, we didn't own 1 2/3 automobile companies. There were different policy options available to Washington. They had less leverage, and the best they could do was mumble about coal to liquids, whimper about natural gas vehicles, and go like crazy for ethanol, which worked, sort of. Now there are actually vehicle technology choices, many of which you've already heard, I won't repeat, but also, quite frankly, the fuel efficiency gains that you're already seeing are an artifact of greater government control. We'll skip this, but we suffered on a national basis from oil as a percentage of GDP about half as much as we did in the 1980s, which doesn't mean it didn't hurt. It hurt a lot, but it was nationally less destructive. What happened after that last one, though, was that we had a wave of demand destruction in cars. People got fed up. 1973 created CAFE standards. In 1979, they mattered. After the Iranian Revolution, people, as soon as they had the money, traded in their cars and destroyed gasoline demand tremendously. The trend line for gasoline demand should go endlessly upward, except it probably won't. We'll get to that. But I'm suggesting there will be a kink. There is, in fact, an artificial lull in the scrappage of cars, passenger cars, right now, because I call it a rich man's rebate. If you were getting the cash for clunkers deal, it meant you had the other $12,000. And the people who don't have very old vehicles. They will be replaced, and when they do, the new cars, whatever they are, will probably be smaller and more fuel efficient. But bring in CAFE standards, and gasoline demand starts trending down. If you average the fleet and you assume an average vehicle life of 12 years, and you look back 12 years at the model year and a very good caution from the prior presenter, whatever the listed fuel economy is, whether it's measured in greenhouse gas emissions per mile or whether it's measured in miles per gallon, is low relative to what it really does. But in any case, you could actually see in either one of those situations, gasoline climbed like a happy upwards curve or kinks before it climbs. They now trend downward in 2012 or 2013 because of this change in CAFE standards that this administration has invoked. That's a real change. If Copenhagen came true, before Copenhagen we were talking about the Oil Conservation Treaty of Copenhagen. In principle it is. What we're saying is that if everybody kept the same share of emissions in their economy that they have now from oil and still made their commitments in Copenhagen, assuming a number of different things, they have high and low targets in different countries. The IEA and the EIA have different expectations for where India and China are right now. But take sort of the high end of the case, you have about 3 million barrels per day of demand destruction at the high end just by keeping your word. And in all likelihood, you'll destroy more oil demand in developed countries than you will relative to other emission sources because power is important. Now, what that means is that the IEA sees approximately 10 million barrels per day of demand growth. EIA sees approximately 15. What if somewhere between 20% and 30% of that weren't there? Could affect price. Then there's the ethanol story. Distillate fuel oil can be replaced by biodiesel, but we'll see if that ever really happens. We have a mandate that says it should. We know, anyway, that the first generation of ethanol will displace gasoline in our fuel supply, which means that depending on whether or not you believe in cellulosic ethanol, and depending what you believe about the demand of the future, you have somewhere between 7.6 and 8.5% of 2020 gasoline demand being eroded by biofuels, somewhere between 8.3 and 9.4% by biodiesel, and if the Pickens plan came true, and heavy trucks, 18-wheelers, ran on natural gas, another 17 to 19% of distillate demand gone, which is why the slide says don't let your babies grow up to be refiners, because there's two problems here. The first is your market for your product just got smaller, but second, it got smaller in a weird way. You now have way more diesel fuel than you know what to do with. I won't go into it, but subsidized demand in other countries has a carbon impact. If it goes away, it will also have an oil price impact. I don't think it'll go away. We can go into markets later. I think what's important is really to get to sort of the conclusions that I'm trying to suggest. First of all, it takes a dislocation to get change. That dislocation can either be a very strong policy or an absence of supply. We are not in the presence of either of those right now. Second, when that happens, it will have economic effects that are disproportionately borne by different parts of a society, ours especially. I think that's important. And third, should it happen, it might stave off some of these cataclysmic predictions that oil prices will go through the roof, which in turn will undermine some of the economic motivation to switch fuels or technologies. Thanks.
We're running late on time, so if
Okay.
we do the
Being
consumer
last, I'm
stuff.
told to actually adhere to the time limit. Well, of course, we need to get started. What is this now?
Here,
Okay,
so
you can
wanna
go back
ahead,
one.
Forward.
Back.
All right,
Which is back? This side's back?
that's back, that's forward.
Okay, well,
And
I
you
was,
point that way.
I was actually going to do exactly the same set of issues, but with a different proposition. I want to talk about a possibility, not a prediction. and a possibility that's really important. It's a possibility that really should apply in the world if we had the courage to address the fundamental market failures that afflict both the supply side and the demand side of the markets. And consumers are the victims in this piece, not the villains. They have a bum rap and a raw deal, and it's only a question of whether they can get policymakers to actually admit that neither the supply side on the oil market nor the supply side in the auto market actually works, and thereby adopt policies that make the market work more efficiently. I'm not going to have a lot of time to do this. How much does a barrel of oil cost to find? Adam Szymanski says about $70. That's only because of a systematic underinvestment of production capacity in the places in the world where it would cost $10. But if you accept $70, you understand that we had something funny go on in 1980, 1970, 2008, 2007, 2008. I like to use the EIA has a model that predicts the actual cost of oil, and they did terrifically until something started to happen. And they kept saying Szymanski's $60 or $70 a barrel was the right price, and of course we got to $140 a barrel. Why? Well, here's our expected OPEC excess capacity. No big change in expected excess capacity, but price went crazy. Here's the global reserve to production ratio. You don't have change constant doesn't cause change. In order to have explanation, you need change, temporal relationship, and economic theory. If you don't have change, you can't explain change. So this was the fundamentals that the Wall Street analysts ran around with and told me why $140 a barrel was right. There is an explanation. It has to do with speculation. I believe that the price of oil has three components to it. I was actually asked this question on a panel with George Soros. Maria Cantwell said, is there an oil bubble? He said he couldn't tell. And actually the other four witnesses said they couldn't tell. I was the only one who said there is a bubble, and it is composed of three things. The price of oil at the time was $120. It's 40, 40, 40. $40 for cost, $40 for monopoly rents, and $40 for speculation. Ultimately, it went up higher. The interesting thing is that you can count the amount of money flowing into speculation, and if I advance this chart, the money left, and the price went down. It left because government actually began to regulate and threatened to regulate, and then, of course, people ran out of money. You can also identify specifically policy changes that invited the money into the market. We invited the money into the market through a series of policy changes, including the Enron loophole and several SEC decisions, which, of course, is always encouraging because if policy can invite money into a market, it can chase the money out of the market, which the Commodity Futures Trading Commission is actually in process of trying to do. They're about to set a speculative limit. And so once you hit this limit, people are not going to be allowed to speculate. And that's actually a good thing because there's too much liquidity in this market. However, that's a pretty picture. This is what happens when both the rents and the speculation are driven out of the market. We've lately got the rents back in. The speculation hasn't yet come back, and we'll see if it can or does. The really interesting question we want to ask is what can we do to keep the speculators out of the market, and what could we do to actually get the rent seekers under control? I can't make them go away. I've let them exist for too long. And that's on the demand side. And as I said, the consumer got a bum rap. This is 2002 to 2005. When those consumers went into the showrooms to buy vehicles, they actually rewarded people for more fuel-efficient cars. The automakers never noticed, or if they noticed, they try to convince themselves it wasn't true and discount trucks. So GM was pushing trucks into the production line, and when they got out the back door, they were money losers. Of course, they had to discount them so much to move them off the lots, but they kept pushing them in the front door because they swore the consumers didn't know what they were doing, and eventually they start buying that junk. This is 02 to 05. What I've done here is I've plotted each year the reward to the change in sales by the miles per gallon. And you know what? It works its way up exactly. The automakers kept asking consumers with their idiot surveys, what are you willing to pay for? And they kept manufacturing the wrong things. Eventually, they ran out of luck in the recession. So looking back to 02, 04, 06, you will discover that it all happened well before the 08 price bubble. It's a wonderful study by CBO in California, which counts every car, every inch on the road. And they found the most remarkable perfect relationship. If you look at the highways where Caltran, the train, runs along, they could count the number of cars reduced during rush hour and find one additional body on the train for every car that got off the road. Consumers did, in fact, react to this stuff. If you ask consumers a question, what do you want? What do you drive? What do you want? Right? And compare that to what the manufacturers were making, they were not giving people the cars that they wanted. Now, when you walk into a showroom and ask people, are they willing to drive smaller cars? The answer is yes. Are they willing to have fewer cylinders? The answer is yes. That's what we've discovered in 09. They stopped buying cars, but above all, they stopped buying cars that don't make any sense in a high-price world. But there you go. But what were the manufacturers making? If you look, remember my graph which showed that people wanted 30 mpg cars, they kept making more and more of the stuff that people didn't want to buy. Now, the question you ask is, why did consumers buy them in 06 and 07? The difficulty is that when you walk into a showroom and the only thing you see is what's there and you need a new car, you end up buying the wrong things, the things you didn't want, but you need a car. If you look at the Cash for Clunkers program, which was a wonderful success, what you will find is that in the first week, people cleaned the shelves of the high gasoline mileage cars. And then the people who walked in the second week, they had this discount and they wanted to buy something. They had to buy what was there, and so they bought it. So week by week, they bought worse and worse cars, but they were still 3 times as good as the cars Congress told them they had to buy to get the discount. What we need, of course, is the consumer needs help to make the automakers build the cars that the consumers want. This is a market failure of monumental proportions. How do you get it? You raise CAFE standards. I put this little X here. This is our proposal for 40 by 2020. And the previous speaker mentioned what happens to gasoline demand if we actually do this stuff and stick with it. Finally, we shouldn't forget about the supply side. So here is a chart that tells you that there is no economic reason, even with a cartel, that the price of oil should go above $100 a barrel. In a rational world, there is no, even that $100 includes all those damn cartel rents, but we have surrendered to that. We will never do anything about it. But there's enough alternatives, starting, of course, with efficiency, so that the amount of excess capacity in the world will always be sufficient to discipline the speculators and keep the pressure on the cartel. It's, of course, as a consumer advocate, my fervent hope would be that if you put enough pressure on the cartel, what happens is, of course, is it breaks. It's easy to run a cartel when your pocket's full of money, which is where they are today. You go back to the 1990s and the cartel collapsed because the price of oil was low and everybody cheated. I have to get back to a world where there's enough reduction in demand so that the members of the cartel start to cheat. Last point about Copenhagen. The previous speaker said, if Copenhagen, then. If the commitment in Waxman-Markey were effective, it means 2 things that are really important for consumers and public policy. 1, the gasoline engine is history.
Companies right now have a lot of market power, and that's the economic rents he talked about. Their market power is growing, and as low-cost producers, they'll crowd out the U.S. companies. And so some of those outcomes are potentially more disruptive, have more economic impacts that slow us down. But we could certainly get there. The trend line is set. we wake up from our sleep, economic growth rebounds, and the surplus capacity isn't there, price will very quickly appreciate.
So price appreciating means we could get to $200 a barrel oil.
Well, my contention is that the numbers are sort of arbitrary, but there's a point at which you collapse the demand very radically. Nothing is as radical as a disruption.
Okay.
People buy new cars then.
Right. And one of the issues of the disruption is that is something that would really create dramatic change, but both good and bad.
Yeah, I mean, I don't think anyone who grew up in sort of the 1970s and remembers all the things, or people who lived through it the first time, nobody wants to do that ever again. That was a period of economic vulnerability no one wants to replicate. But it did bring the first and only major policy-driven change in the way we approach demand in this country and the fuels portfolio. It would certainly do it again, but I don't think anyone wants that.
Mm-hmm. Mark, did you want to talk about that?
No, unfortunately, I actually analyzed the 1970s. So when I came to Washington, but the assumption that disruption leads to rational positive change is highly dubious. This is the fundamental problem here. The notion that if we do certain things we can defuse the bomb, bombs go off and we won't even admit that it happened. And the remarkable thing is, if you look, let's take the course of financial services reform over the last year. By all accounts, a bomb went off. Now, it's not the kind of bomb that, you can see. You would have thought that we would have quickly evolved a consensus that we need more regulation in this market to prevent bombs from going off. You will also observe that that did not happen by any stretch of the imagination. So the assertion that there's a consensus that we need regulatory policy to correct the market failures is only a hope on my part. There's no reason to believe that you will not get a full-fledged press of free market ideology which says, no, let's just let the marketplace do it. Look at California. California's about to try and set another round of standards for vehicles. It's liable to be a lot more aggressive than the last round. I guarantee you there will be screaming and shouting about how the Californians are intervening in the marketplace where they have no business. Even though we own the car companies, they're going to go into opposition to it because it's going to be serious business. It may actually cause everybody to drive smaller cars, which is something the public is willing to do, but policymakers are unwilling to help the public do it. So for me, my possibility requires a fundamental change, a willingness to admit market failure and take steps to correct it. That is not the predominant view in America, in this market where it's so obvious, in the financial sector where it's so obvious, healthcare where it's perhaps not as obvious. But so my answer is, I'm not sure this leads me to good policy. It may lead me to more pain.
Okay. Russell, perhaps you'd like to talk. One of the morals of your graphs is that the kind of advanced vehicles that we may need competitively to compete in the world will require big government incentives and a big push in terms of regulation and support. Would that be correct?
Yeah, I think it. So it depends where you sit, right? If you're in other countries, if you're in Denmark, for example, you get a $30,000 advantage if you drive an electric vehicle over an internal combustion engine vehicle. If you're in Israel, you get a 70% tax advantage that's going to last 10 years. So it all depends the way that things are structured. But the way, again, the evidence would suggest, based on the consumer research that we've done, based on the consumer isn't going to move here. You're going to have a catalyst, which it's not going to drive the mass adoption that would be required.
What do you think, this is to the panel as a whole, what is the catalyst that drives the catalyst? How do we, if we don't have another sort of shock, what are the political and emotional and economic levers that move us towards a really low demand path?
or that move us to push these sorts of vehicles?
So, if I may just start and start the discussion, I think there's basically four big things that you think about, right, when you think about the environment here. From a technology standpoint, you would say that the technology for EVs is in its infancy. Again, we've never produced batteries in the volumes or at the size that we will, required if this thing does take off in the near term. But the technology is getting there, and the cost of the technology is coming down. Again, that's something that will happen in the next few years, and the cost will come down to a point where, as you saw from the charts, within Europe, where the gas price is quite different from where it is here, it makes a ton of sense. Second thing, from a macroeconomics, I think we've discussed it, right? We've talked about, some of the prices, where the prices could go to. If it stays anywhere near it is today, then, the only thing that's going to change is the battery cost comes down and again, makes the TCO, as I discussed, the total cost more appealing. You would say regulation. Well, actually, I think to the chart Dr. Cooper showed, I think I had it actually in backup, the same chart. We are, in 2015, we're about 25 to 30% behind Europe in terms of emissions. We measure it miles per gallon. Europe measures it in grams of CO2 at the tailpipe. Again, that 25% doesn't bode well when you think about regulation drives innovation. Therefore, your national or regional automakers basically play to your regulation. Therefore, it's no surprise that European and Japanese standards are where they are, and their players are where they are in terms of fuel efficiency and the like. And then the final piece of the puzzle is the demand, right? And we're saying that the demand isn't there initially, but again, over the next, and I know we laugh about cellulosic fuel being 6 years away, always has been 6 years, an eternal 6 years, but again, you can see some moves, you can see the availability of vehicles, you can see charging infrastructures being put in place, you can see bold moves by major cities like Paris, like New York, like Shanghai, that again will act as a catalyst but won't be sufficient to drive the mass market.
I think Dr. Cooper and I would probably, he'll win because he's got, I think, nicer charts also. But we fundamentally disagree on the component of the spike in the market price for crude oil that was made up by speculators. But I don't think we disagree that the outcome was undesirable, that volatility destroys wealth, and that whatever you can do to avoid that should happen. The problem is that as a policy sort of framework, this government does not have the ability to effectively change those things. There is no automotive efficiency police that will chase you down and make you accountable for buying a more efficient car, nor do we have market power to control the outcomes with OPEC. To the extent that speculators wait for moments of physical scarcity, I would submit, just for the record, I'm certainly not taking a side here, but in my numbers, speculation plays a smaller part of the numbers because I can actually point to real periods of physical scarcity, not on an annual basis where my numbers were, but when a well-known Western oil company bought a westbound single-hull tanker of crude oil at $30 above the market price in Europe in July of 2008, it did two things. One, it signaled real scarcity. And second, any speculator watching that bought like crazy. Now, if they'd been watching something besides themselves on TV on CNBC and looked at what the Saudis were doing, the Saudis lowered their price. They knew what physical demand was going to do because they saw it contracting. So at that point, you can find a speculative premium and you can be relatively sure. On the front end or in the back end, it's harder to do. But in any case, nobody wants this. We want a market to function well. We don't want to engender market dysfunction and hurt everybody along the way to produce change. So I think that actually the technology solutions are generally the pathway forward. The demand side benefits, though, that we are already seeing, I don't think we should discount the way that consumer will behave when the price recovers. In history, the effect of having CAFE standards, and Dr. Cooper's absolutely right, if we stick to them, if they happen, those CAFE standards will do something to start transitioning us into a different vehicle size, a different way of thinking about our cars. If they didn't happen, they'd probably get us to electric vehicles sooner, and that's the irony and perhaps the sad irony of all of this.
The interesting thing is I will agree with one proposition that's implicit in what you said, and something that's really hard to make policymakers accept. The price of crude oil is set on the NYMEX by the American gasoline price, it now turns out, is that people look at that number, particularly OPEC, and they calculate the rents involved. And when they see the price of Western WTI or gasoline way up, they discover that the refiners are getting a big margin, and they say, "That's my money." There's a famous line in Clear and Present Danger, one of the movies where the drug cartel lord has seen that the president has announced $675 million has been recovered, and he says, "That's my money." I mean, he stole it, and he thinks it's his money. Well, that's the way the Saudis look at the price of gasoline in the U.S., and they are a rent-seeking cartel. So the price of gasoline sets the price of crude oil, particularly the price of gasoline in NYMEX, which is, after all, 1/4 of the world market for gasoline. It is the marginal supplier or the marginal market, and will remain such. Second, the history of cafe. In the 70s, when it was introduced, in the early 80s, the economists insisted it didn't matter. And then, of course, the price of gasoline collapsed, and the fuel economy of cars kept going up. So the American consumer, they didn't have to buy those more fuel-efficient cars, but the automakers had an incentive, that is, in theory, fines that would be imposed upon if they didn't hit the targets, and they started to manufacture more fuel-efficient cars, and they were in the showrooms, and people kept buying them, even though, if you look at my graphs, the price of gasoline was flat for 15 years. Eventually, the automakers decided that they had enough of this. My God, they were forced to innovate on a regular basis. Heaven forbid a company should do that. And they went to Congress and said, "Get rid of these increasing fuel economy standards." And for 15 years, we were dead flat. We could have made them keep increasing fuel economy, and consumers would have kept buying them. Why? Because automakers would have stocked the showrooms and advertised the right cars. But we chose not to. So regulation, especially on the demand side, especially as it afflicts the automakers, can in fact play an important role, I believe, in making the market we all want. $100 oil, $200 oil is ridiculous. The economic cost of producing the commodity is a fraction of that. And you cannot run a world economy when you have people overcharging you for the economics of what they deliver to the market. Eventually that market goes very bad, which is what we've suffered from in oil for several decades.
Can I just very, very quickly, there's two things that I would just submit maybe somewhat different. One is that the Saudis have stopped pricing their westbound cargoes using WTI. You can conclude from that whatever you want. Their rationale is that it's not the oil they sell. It's not the oil they price on anymore. And second, we are 11% of global liquids in U.S. gasoline, which means that any change in U.S. gasoline, think about its effect on the margins of oil. Right now, we are the swing consumer. We do have demand cartel power. In 2014, in my model, that changes. We no longer have in the realistic realm of possibility that at our disposal. So, in essence, it is true today that gasoline here in the U.S. changes the global price for oil.
I think to hinge on this, one of the things that's interesting when we lose that demand, we are the demand cartel, all of us with our feet on the gas pedal. When we lose that power, that will be sort of the end of an era. And we have a couple of other sort of time frames to keep in mind for starting more aggressive regulation or more aggressively helping consumers into different sorts of cars. One of the time frames would be for how long can we maintain, how long do we have, to back up, every car that rolls off the assembly line that is sort of below the par of where we want to be in terms of fuel efficiency is adding extra carbon to the atmosphere, and it'll be in the economy for the next 15 years, and it's also adding extra demand to our oil demand. So one of the things is how long do we have? That means that starting now, we need to actually change the types of cars that people are buying, and how long do we have in the longer term to be competitive as with electric vehicles. Russell, if you could take this one, and then we'll move on kind of quickly to the other two.
How long do we have? Maybe I come back with a question. How big of an issue do we think it is? Right. Again, when you look at where the regulations are, and I think it's worth pointing out a little bit about the European regulation. One of the things I didn't show is that if you took the emissions of the average fleet by the European folks that they were selling in Europe. The fines that would have been put upon them were actually greater than the global profits of the industry in 2007. They reached about 58 million. It was maybe on par with the global industry. So the regulation has real teeth, right, is the point. So it's not whether you comply or you don't comply. You have to comply, otherwise you're out of business. If you want to play the game, here's the table stakes, and you have to play. You have to play with it within that sandbox. In terms of time, I think it's we haven't got very long. The reason I say it is because the other element, I think, Lisa, in all of this is typically we take. You may think it's slow, but it is what it is. We take about 5 years to develop a new car. We take about 8 years to develop a new engine, and we take about 12 to 15 years to develop a new transmission. So what you're driving today was basically designed, if it's a vehicle at the vehicle level, the platform level, about 4 to 5 years ago. Your engines were designed about 5 to 8 years ago. Again, if you're buying a new car today. So these things take time to come. An EV, electric vehicle, again, we're in the infancy today. But maybe you could look at it and say it's a little bit simpler. We haven't got quite as many components, so maybe it could be a little bit more advanced in terms of the timing, maybe. But you've still got to go through all the durability, reliability. One thing consumers will not stand for is any reduction in the quality, whether that's how long things can drive for, or again the feel, the quality feel you get within a vehicle. The challenge is, right, if you look at the market today in the US, the Japanese clearly have been winning, or the Koreans have been winning. They've got, it just so happens, stringent regulation for fuel economy in their home markets, and they've got vehicles that are typically, again, you look at some of the recent adverts, maybe not the case, but typically more fuel economic than the things that are made domestically. And how do you catch up, right?
Right.
Unless you fundamentally change the regulation domestically, you never catch up. And I already said we're 20 to 30% behind Europe 2015. I take my hat off. I think what we did for 2015 is certainly a fundamental step in the right direction. But if we're ever to catch up and create world-class products that other markets actually absolutely desire, then we need to make a fundamental step forward in the level of the regulation and the teeth that comes with it.
Immediately, then, pretty much.
Pretty much.
I defer to that. He knows the cars, and I think that is the constraint.
One observation I would offer, we heard a lot about how long it takes the U.S. auto. I guess those were industry averages. It does also turn out that the faster you are, the shorter you take to respond, the more profitable you've been during a time of change. And so one of the things that the auto industry has to do is become more nimble. That's a real popular consultant's word, right? The industry has been far too slow. Half the problem was they refused to recognize the market reality, which I think they've been hit over the head with sufficiently. And only if you clean out the management will you actually change the behaviors. I think the notion that you build an export industry by creating a home environment where they still do have the majority of sales is something that even free marketeers ought to understand, but it's very difficult to get them to recognize that regulating the home industry actually gives you a better industry on a global basis. They'll insist that any regulation destroys every industry.
Okay. There are two things I want to talk about. I want to go to questions. One thing is, the big question here is, are consumers willing to pay for this? They're going to pay one way or another. They're going to pay through the vehicles themselves. They're going to pay through oil prices or a carbon price, and they're also going to pay through cost to the economy of whatever happens in the oil markets. And I think we will hopefully talk a little bit about that in the Q&A period about what consumers are willing to bear. But just before we move to that, I want to get your sense. We have sort of three choices as policy wonk type people. Do you do this regulation that we're talking about on the basis of a carbon, some sort of carbon regulation? Do you do it on the basis of energy security, or you do it on the basis of job creation? And I wonder, amongst the three of you, where do you come down on that?
Well, I'm happy to say that the policy we have for energy security was ethanol, and last 2008 it performed admirably. Not everybody likes all the aspects of it, but it worked. The Strategic Petroleum Reserve, some say it should have been sold. I would contend otherwise, but it exists, it works. Energy security has been a dominant force in energy policy. The environmental responsibility and consumer protection have not been. Perhaps all three do coalesce. I think that's a sweet spot, but I think energy security generally gets things done.
I emphatically agree. Carbon, climate is not something you can convince the American people to adopt policy on the basis of. I think a tragic mistake was made spending the first year on climate policy instead of energy policy. The notion of building a more fuel-efficient economy, of creating a less dependent, energy-dependent and oil-dependent economy are things that actually do motivate people. We ask people these questions every 6 months, and we get overwhelming support for fuel economy standards. We get strong recognition of the problem of oil dependence. When George Bush talks about an oil addiction, you ought to know that that was something you could message around. Climate and carbon are simply not on the radar screen of the average American. Maybe that's a shame, maybe that's not, but you have to govern the country you live in. And energy security and energy efficiency are things you can probably message around and motivate people on.
Okay, and so I want to ask Russell a question. Yes, you have to govern the country that you live in, but you need to make jobs for the kids who are in 7th grade right now. And I think in thinking ahead 10 years to where we have for our auto industry, is the energy security angle the best way to go?
To create jobs?
In the long term for competitiveness, is energy security the way to go, in your opinion?
My opinion, I look at the three things and think. I think to the first point that was made that there's a lot of overlap between the three of them. I think two have got more of a domestic flavor. One's got more of a global flavor. And like it or not, the rest of the globe looks at the U.S. and looks at the moves the U.S. makes, and probably more often than not takes that as the direction that much of the globe should go, believe it or not. So is looking for the U.S. to take some leadership. Certainly on the climate front, is that part of being a global citizen? Is that helping with the domestic job? Ideally, the answer would be you would do both. But again, you look to more specifically, you look to the auto industry and you say, if we can't afford not to advance our technology and innovate. Otherwise, we just fall further behind, and we continue to buy cars from Japan, Korea, and more so China.
One additional point here, and Russell has said it a couple times. If you can't export the stuff you build, it's not going to be an important industry. The rest of the globe is too important and growing too fast as markets in order for you to produce and sustain, create jobs. If you don't have export industries, you can't create jobs because the rest of the world will be more efficient and you will be importing their jobs as opposed to exporting product that creates jobs at home. And that's a message that if you look out in the environment of the policy debate, it just doesn't get enough attention, in my opinion.
I agree, and I think one thing that comes to mind is that Senator McCaskill said on the issue of carbon prices, we want to be a leader, but we don't want to be a sucker. And I think that there is this, the U.S. is really going to have to figure out how to be a leader on our own terms in this, because we're not. whatever the cost of potentially being a sucker in the global scheme of things now is, the cost of being a long-term sucker and not having jobs 10 or 15 years out in the auto industry is, I think, pretty calamitous. I'd like to break now and go to questions from the audience, and during that we'll kind of weave in the question of whether consumers are willing to pay. So, the microphone's coming to you.
All of the people that do projections of food prices, the big organizations in the Midwest that we rely on for these estimates, say that the price of food is now determined by the price of oil. And so it's very interesting to hear discussions among energy experts and automobile experts and so on, but I think you need a fourth person up here who's sort of a food expert, because basically we've created a system that is linked to the worst food crisis in 30 years, and if energy prices go back up and food prices go back up, you get a tremendous amount of destruction of ecosystems as agriculture expands to try to take advantage of the higher prices. So, I think that there's a lot of consensus amongst the people that aren't here about how all of this affects the price of crops. And so I appreciate. I work on agriculture, and it's interesting to hear what you folks know about your field. But one of the problems here is that we're dealing with something that really is linked to both things.
I think this really speaks to the issue of we have a very narrow window of time to act to really reduce demand and to influence prices to prevent the sort of the spiraling out of the issue of oil prices into agriculture. Does anyone have a specific response to that?
I would. I mentioned ethanol, and I think there's an easy link to make there. The world eats what we're driving 10% in our tanks right now, and the defensible argument for ethanol is that there's a pathway to non-food crop biofuels. If you believe that, great. The other defensible argument is in 2008 it saved our gasoline supply. But if you look at what you're doing, it's a challenging proposition. I think no one in this city I've ever heard speak has ever had the courage to say 100% of food price inflation was associated with ethanol in the program. But if you think of two classes of buyers, and I'm not sure it is 100, but the commercial buyer of grains for foods tops out at a price where, if you look at what's in Budweiser, it's whatever grain was cheap that day plus yeast and water. At some point, the product's buyers stopped buying because they couldn't sell their product. They couldn't pass it through. But you could go all the way up to $8 or $9 a barrel, $8 or $9 a bushel rather, for corn at the height of the oil prices and still make money.
Yeah. The other issue had to do with the massive subsidies for that,
right?
Which were really, really supported when the price was high. Let's go on to the next question. Yes.
Yes, thank you. I'm Jed Schilling with the Millennium Institute, and suggest that this needs to be put in a broader framework of the rest of the economy. We presented our Threshold 21 model here. It's a complete model of the U.S. economy focused on energy. It was used by congressmen in looking at the CAFE standard, and it demonstrated that by imposing that, while you would cost the automobile industry $30 billion, the rest of the economy would benefit much more, and the overall growth in GDP would be higher, and the price of fuel would be lower, which helped a lot of people and made up for the benefit. So I think it's very important to put this in a broader context and look at the importance, I'd like some comments on that, and look at the importance of the kind of regulation. Because while several of you mentioned the idea of moving back to a more market-based economy, I think you also had noted that the economy that we're dealing with, particularly with oil and autos, is fundamentally imperfect. It's basic natural monopolies, it's oligopolies, and the other problem it faces is it controls Congress, so the government regulation doesn't reduce the imperfections, but increases the imperfections in the many aspects of the economy by not increasing the CAFE standards and things like that.
Do you have a specific question?
So how do we make sure that the regulations that are imposed lead us more toward a beneficial set of results and don't further the imperfections of the economy by favoring the special interest groups and the oligopolies.
Well, and Lisa keeps talking about how much the climate change legislation will cost, cap and trade or a carbon tax. Actually, we believe that certainly the first decade and a half doesn't have to cost much. And it goes to exactly the question that's been raised here. There's a slide in there. You can go to the National Research Council, look at their report on America's energy future. And you will observe two really interesting facts. Electricity costs 9 cents a kilowatt hour today for the residential customer. They estimate it costs about 2.5 cents to save a kilowatt hour. So the average consumer can save 6.5 cents by consuming a kilowatt hour less. If you look at the NHTSA or EPA analysis, and we're about to stop measuring fuel economy or cars by fuel economy and transfer the authority to EPA, so they'll do it by a tailpipe emission, so we'll catch up with Europe. If you look at their numbers, it costs about $3.25 to consume a gallon of gasoline. It costs about $1.25 to conserve it, which is the basic economic analysis. So you have this really interesting question. If it costs 9 cents or $3.25 to consume and $1.25 to save, why don't consumers save more? I mean, in a capitalist economy, when something is cheap and abundant, well, maybe it's not so abundant. If it's cheap, you would expect people to invest more and more in that. The answer is there's a market imperfection there, preventing consumers from buying the cheaper commodity, i.e. conservation, and the answer is it's the automakers. In the electricity sector, there's a whole host of reasons why people don't buy the efficiency. So the answer is that, and I agree entirely, a rational public policy. The other question, of course, is what makes you think adding another 50 cents a gallon to the price of gasoline is going to get people to buy more efficiency? I've already left $2 on the table. Now the people who come along and say, let's tax it, are going to say the advantage is $2.50. But if $2 didn't work, why is $2.50 going to work? The price signal doesn't work very well in these energy markets. I paid 9 cents for electricity. I could save it for 2.5 cents. Why does raising the price to 12 cents make such a big difference? I've already left all that money on the table. That's exactly why you need public policy to mandate behavior, because the price signal doesn't work very well in energy markets.
And I think that's one of the real challenges of this, is that you really need to, because people are not always investing in efficiency, you need to figure out how to overcome those barriers and figure out how to let people invest in the efficiency. I think Kevin's suggestion that the fourth quintile is kind of stuck consuming a lot more energy than they'd like to is really interesting, and it suggests that there's ways to help them consume a lot less energy, possibly by making credit available to them. Cash for clunkers only affects people who have lots and lots of credit and who can buy a new car, and some sort of program that's aimed at the fourth quintile might help them reduce the amount that they use. Next question. Yes?
Yeah, Chia Chen, freelance correspondent. Seems what we talk here is not to the title. Title is a reduction of the carbon monoxide, and most is on the oil price. Sure, oil price is important, and here I had argued about this, how much a contribution of the speculation. Speculation is a factor, but in my view, the most important is we practice, not the market capitalism. We protect the Wall Street capitalism. So that's the problem. And also that
Could you give us a question? Because since we're starting to run out of time.
Okay. The question is this: why we not talk about the reduction of the carbon monoxide? And I think this is important is. Mostly depend on the.
Do you mean carbon monoxide or carbon dioxide?
Carbon dioxide. But my question is this: how come we get cars bigger and bigger? That's really nothing help in this thing.
I-
How this formation of this bigger car.
Okay. I think we've dealt with that to a fair extent, if any of you want to talk to that. More questions further from the back?
This is a question for Mr. Hensley. In your models that you put together for future consumption, what, if any, constraints did you have in there for other capacity constraints, such as when looking at ethanol, how much farmland is used? When looking at hydrogen, what infrastructure is necessary? When looking at some of the battery technologies, whether you have the raw minerals, what do those constraints dictate about oil prices, and at any of those points do they meet a possibility at frontier where it just can't expand further? Thank you.
Yeah, so I think I'll let Kevin speak about the interactions with the prices, but the in terms of constraints, what we looked at in terms of biofuel, we said we looked at a non-constrained world. So we said if let's look at what we would call not best practice, but what's the where's it got the highest penetration in the world today, and if we reach those levels, then what kind of abatement would we achieve? So again, you look at the country like Brazil, which again is the 40% or just south of 40% in terms of penetration, and use that and say, okay, if we were at that level, if you imagined a world where we got to that level, again unconstrained, then this is how much abatement that you could achieve. In terms of I think your other part of your question was battery constraints in the materials, lithium and lithium ion. I think there's a belief the amount of lithium. There's a bit of a myth in the world that how much lithium goes into a lithium ion battery. It's not a great deal, and the limitations of lithium. I think there's a plentiful supply of lithium. Once we run out of it in some of the probably more dangerous parts of the world, I think again we can begin to retrieve it out of other places like the ocean, where there is again some supply of lithium. So it wouldn't seem that is a constraint at this point. But we didn't look at the interaction on pricing. I don't know if you want to speak to that.
Government mandates that inject tremendous demand into something that hasn't previously seen it can create really bad dislocations. Polysilicon prices rose tremendously with the growth of the government-mandated solar market. Corn prices rose tremendously as a result of ethanol. It's reasonable to assume, I haven't modeled lithium in mine, I looked at cropland, at ethanol. All these constraints are caused by one fundamental thing that nobody really wants to accept, which is that oil is a great carrier for energy. Refined product works with the equipment we have, and if we try to find the cheapest alternative and then superimpose the weight of oil demand onto that alternative, we crush it. These can only be supplements, they cannot be substitutes. And I don't want to sound too much like a free marketer and get a right hook from Dr. Cooper, but if you didn't put so much sort of mandated demand on top of these alternatives, it's possible that the market might have ferreted out natural demand before legislative demand created dislocations.
Another question? Yes.
Spurgeon Keeney. Could the panel say a little bit more about the form that speculation takes and has taken, since there's given some difference of opinion how extensive it is, and what can be done to control it in the present environment?
Do you want to speak to that very quickly?
Well, I can look. Since I
think
do,
there's great differences of opinion on this panel, and they do not represent the New America Foundation.
The question about what things can be done about it are there was a simple thing that I think actually had a big impact, is that you can classify speculators as speculators and regulate the amount of speculation. And so for several years, the Commodity Futures Trading Commission let the big banks call themselves commercial traders, not speculators, even though they never take delivery of the product. In the process of doing so, they totally distorted the perception of how much speculation there was in the market. And then over the course of the summer, they decided they would reclassify someone. And they never did exactly say who. And suddenly everyone discovered that 85% of the trading was speculation. The physicals, the commercials, had been driven out of the market. So, or they constitute a small share of the market. And actually, they had been driven out because they couldn't cover their margins and things like that. So the chairman of the CFTC is actually proposing that speculators should not be allowed to be more than a certain percentage, or that individual speculators should not be allowed to hold positions that exceed a certain limit. And of course, you set the limit to the point where physical commercial traders never really need to exceed that. No one's that big, and so it's the speculators who will be impaled. If you do that, you will chase a lot of money out of this market. There was a massive influx of money. Now, the Wall Street people will say, oh my God, you're reducing liquidity. Of course, the problem was excess liquidity. Too much money chasing too few goods. So, very simple, straightforward. These are principles of commodity regulation that were applied for 70 years before the 2000s. And they worked really well for 70 years. We just made a mistake for about a decade, and we can get back to it. And these markets will do. Speculators are important in markets, but they shouldn't completely terrorize the commercials. The market is supposed to exist not to produce financial income, but to assist physical traders to smooth the market. That's their purpose. They can execute it within limits.
I would say that is one of the big existential questions of our time. Is the market? Does the market exist to correctly price the commodity of oil, or does the market exist to allow everybody to get in the scrum and make some money? And I think that we've got a pretty big open question on that. I also think that the issue of regulation is quickly moving out of our hands and moving overseas, because there's lots and lots more commodities changing hands overseas. And if Shanghai ever opens an oil market, that's going to be a very different world with very different issues of transparency. Did you want to respond to that?
Very briefly, I just want to offer a competing viewpoint that may or may not be the opinion of anyone else in this room. The oil market may have also functioned very well in a sense. If you believe in price signals, there was a hell of a price signal that came up. And the speculators who were the agents of their own demise at the end of the day were also the agents of that signal. They bought long when they saw a scarcity, and they leaned on it enough that it collapsed out from under them and they fell down harder than anyone else. That's not desirable. I don't think anyone says that's good public policy. That's what markets do. That's how markets correct. It's never pleasant. If you want the benefits of a market and non-commercial traders, and you are taking the benefit of someone else's money, not the buyer or the seller of the product, but someone injecting money into that market. Is too much in the market now not enough? The only way to know is experiments, and CFTC is in charge of that. So are the exchanges. We'll find out. What I would say, though, before anyone says that this market failed, is to look at it a little bit differently. Maybe our expectations that markets would be docile when they were stretched failed. Maybe it behaved exactly as markets have always historically done.
Okay, so we need to wrap up because we need to leave here. I wanted to ask one sort of final quick question. Can you imagine, do you think that consumers will be willing to pay these costs and the cost of the new cars, the cost of, how are consumers going to react to, like 6 years out from now? Will we be saying, oh, consumers stepped up to the plate, or will we be saying, well, there was a huge backlash? Just kind of a quick thought on that.
Well, the question is how you measure the backlash. If you measure backlash by unelecting the people who are in office when the consumer is grumpy, then there will be backlashes, that's for sure. And the backlashes are not necessarily very rational or in proportion to who's responsible, but there will be backlashes. On the other hand, if you look at the history of the industry, set a steady course for consistently increasing fuel economy, give car automakers the incentive to actually manufacture and fill the showrooms and advertise the right cars, the consumer will actually end up better off. They will have more fuel-efficient cars. That quartile that gets clobbered because they have to drive will suffer less. They figured that out. Look at the junk they turned into the clunkers program. They were stuck with that stuff, and now they figured that out, and they bought better stuff, 3 times better than Congress actually required them to. So I think, and they will. I don't think the price will be that painful if you do a policy that actually maximizes efficiency. And will they be grumpy? They will. And will they throw officials out? They certainly will. But we would consume a lot less energy.
Okay.
So I'd offer 3 things. One is if you look at the vehicle you drive today relative to the one you purchased 10, 15, 20, 30 years ago, you see you get significantly more content. However, you're not really paying very much more when it's inflation adjusted. That has been absorbed somewhere, right? And that somewhere may well be within the industry or within the supply base within the industry. The industry is completely, second point, the industry is completely broken, right? I showed you from the first chart that profits have fallen off a cliff. It took a number of years to get up to the 60 billion global profits. The growth markets, I think as Dr. Cooper said, right, you can look to China. It's now the largest auto market in the world. There's only a few good stories within the industry. The industry is completely broken, which brings me to the third point, which is, what electric vehicles offer, in addition to what we're talking about, is the potential to maybe reevaluate the way that the industry goes to market. So I would encourage that we don't necessarily think of the traditional ways that we've bought and sold vehicles to be the way for the future, but maybe look at slightly different models where there are companies beginning to do that around cities. There are again new models that will be on the fore in the next few years, which hopefully will make for a brighter future. But again, to the first point, if you look historically, the consumer hasn't paid, but the content has been on the rise.
I think the way to get the consumer to do something he or she wouldn't do is to pay subsidies, and you'll need a much bigger clunk than the $3 billion that we've spent so far. By my numbers, you can get adoption at about $75 billion in subsidies. That's a lot of money, and there's a question of whether or not it's a lot of value. And one of the problems is recidivism. IEA in 2000 showed that every time you saved $1 on electricity, you